For centuries, gold and silver have stood the test of time, not just as precious metals, but as symbols of wealth and security. From ancient civilizations using them as a currency to modern investors relying on them as safe havens, their allure has never faded. But here's the real question: do you know how to invest in these timeless assets smartly in today's dynamic financial landscape? Gold and silver aren't just shiny metals, they're your financial armor. With global uncertainty, rising inflation, and market volatility, these assets have taken center stage as trusted hedges. Whether it's safeguarding your portfolio during economic downturns or diversifying your investments for the long term, the relevance today is stronger than ever. Let's break it down step by step. From the different ways you can invest in gold and silver, like physical bullion, ETFs, digital gold, and mining stocks, to understanding the factors that will drive their prices. I'll guide you on how to make these ancient treasures work for you in the modern world. Ready to dive into the glittering world of gold and silver? Let's begin. You're watching Informed Investor, an initiative by Equentis. Gold and silver continue to be highly relevant in today's economic environment for several compelling reasons, making them indispensable components of a well-rounded investment strategy. Rising inflation is one of the biggest concerns for investors as it erodes the purchasing power of traditional currencies over time. Gold and silver have historically been viewed as reliable hedges against inflation because their value tends to increase when the cost of living rises. For instance, when fiat currencies weaken, these metals hold their intrinsic value, ensuring your wealth isn't diminished by inflationary pressures. Let's look at gold returns and inflation data. Just look at 2010 and 2020. When inflation was high, gold returns were 28.6% and 38.1% respectively. Clearly, gold thrives when inflation heats up. Now, what about when inflation is low or declining? Well, gold tends to struggle. For instance, in 2013, 14, and 15, inflation was moderate or dropping, and gold returns were in the red, down by 4.7%, 5.4%, and 5.9% respectively. During such times, gold loses some of its luster. So, yes, while not for all the years, a longer time trend is that gold acts as a hedge against inflation. A diversified portfolio is critical to managing risk, and gold and silver have played a unique role here. They have a low or negative correlation with traditional assets like equities and bonds. Let's take the analysis of capital mind to understand this. The correlation is the measure of how much the price movements of these assets are related, whether they go up or down together. Silver and gold have relatively a strong correlation of 0.63. This means when gold prices tend to rise or fall, silver usually moves in a similar direction, but not as strongly. Silver and Nifty have a very low correlation of 0.15. This suggests that silver price movements don't really align with the Nifty index. When the Nifty moves, silver doesn't necessarily follow the same pattern. They are not strongly connected. Gold and Nifty have a negative correlation of minus 0.05. This means that when Nifty index moves in one direction, gold's price movement is almost independent of it. In simple terms, if the stock market is up, silver or gold might not follow suit, so they could act as safe havens when the market is volatile. This makes them an excellent tool for balancing portfolio volatility, especially during economic downturns or stock market corrections. Gold and silver shine brightest during periods of geopolitical tensions, economic crises, or financial instability. Whether it's a global recession, geopolitical crisis, or a sudden market crash, investors flock to these metals as a safe haven asset. They provide a sense of security, offering stability when other investments become too risky or unpredictable. Unlike paper currencies, which can lose value due to inflation, or digital assets, which are subject to technological and regulatory risks, gold and silver are tangible, finite resources with intrinsic value. This makes them ideal for preserving wealth across generations. History shows that even as economies evolve and paper currencies come and go, these metals retain their purchasing power over the long term. Gold and silver enjoy strong global demand from various sectors, which we will discuss further. Central banks worldwide stockpile gold as a reserve asset, adding to its scarcity and value. Meanwhile, silver is a critical component in industrial applications such as electronics, solar panels, and medical devices, ensuring consistent demand. This dual role as both an industrial and investment metal makes silver particularly unique. Now, investing in precious metals like gold and silver can be exciting, but they each have unique characteristics that make them suitable for different kinds of investors. Let's break this down. Silver isn't just a shiny metal, it's also a workhorse for industries. Did you know that about half of all silver is used in high tech applications like smartphones, solar panels, and automobile electrical systems? This means silver's demand often rises when the economy is growing. Gold, on the other hand, is primarily used for jewelry and as an investment, making it less tied to the ups and downs of the global economy. If you're someone who's okay with price swings, silver might catch your eye. Its prices can be 2 to 3 times more volatile than gold on any given day. While this creates opportunities for the short term traders, it also means higher risk, which could be unnerving for those with a low risk appetite. Standard deviation measures how much prices swing up and down. A higher number means more volatility. Its standard deviation, 26.6%, indicates it's nearly twice as volatile as gold. Also, since 1991, silver has had 16 years of losses, while gold has had 8 years of losses. Gold is often called as a safe haven asset. Why? Because it tends to perform well in times of economic turmoil. Gold has very little correlation with stocks, bonds, and other commodities, which makes it a powerful tool to diversify a portfolio. Silver, while helpful for diversification, doesn't have the same level of insurance like characteristics as gold. Let's talk about accessibility. On a per ounce basis, silver is significantly cheaper than gold. This makes it easier for small retail investors to buy and hold as physical assets. Now, to summarize, gold is a powerful diversifier with steady performance suitable for risk averse investors seeking portfolio insurance. Silver, which is attractive for those looking for higher growth potential and willing to endure volatility, especially as its industrial applications grow. Example, solar energy and electronics. Both gold and silver have seen impressive gains this year, driven largely by rising geopolitical tensions and uncertainty surrounding the US presidential elections. However, the performance has been affected by recent market dynamics. The early months of November saw a decline in gold and silver prices due to rising US Treasury yields, a stronger dollar, and mixed signals from the Federal Reserve about future interest rate cuts. Additionally, China's policy announcements have fallen short of investor expectations, further dampening enthusiasm for these metals. While gold and silver is subdued this month, we must always look at the longer term trends that will drive its price. Let's focus on that. Now, talk about the factors that will drive silver prices. One of the biggest reasons silver prices are climbing is its demand in industries, especially with the shift towards green energy. Did you know that solar panels alone are expected to use around 20% of the world's silver supply by 2027? And this could even go higher by 2050 as countries push for renewable energy. Then we've got EVs. Silver is super important in electric vehicle batteries and electrical systems. As more people switch to electric cars, the demand for silver is going to skyrocket. So silver isn't just about shiny jewelry anymore. It's a critical part of future of the energy and transportation. Silver isn't just an industrial metal. It's also a safe haven asset like gold, though not strongly. Whether there's a war, political tensions, or even economic slowdown, people rush to assets like silver to protect their money. For example, during the Russia-Ukraine war, silver prices saw a spike. And right now, with tensions in Israel and Gaza, we're seeing a similar trend. It's like a financial safety net during uncertain times. Now, this is where silver gets really interesting. It's harder to produce than you might think. Like gold, silver is usually mined as a byproduct when extracting metals like copper or zinc. So, if there's more demand, we can't just ramp up production quickly. In fact, for the last 3 years, the world has used more silver than it has produced. The supply demand gap isn't going away anytime soon, especially with the growing needs of renewable energy and healthcare. Here's another factor. Central banks like the US Federal Reserve have been cutting interest rates. When this happens, silver becomes more attractive because it doesn't pay interest but still holds its value. Plus, with inflation still being a big concern, silver is seen as a great hedge, basically a way to protect your money from losing value. Now, let's not forget about India. India is the largest consumer of silver in the world, and demand here is driven by two big factors. Renewable energy. The government's push for solar energy means more silver is needed. And let's face it, Indians love silver jewelry. With rising incomes, demand for silver ornaments is only going up. All of this puts even more pressure on the limited supply of silver globally. Now, what's next for silver? If you think about it, these factors aren't going anytime soon. Industrial demand for silver is only going to grow with the rise of renewables, EVs, and healthcare technology. Geopolitical uncertainties and inflation concerns will continue to make silver a popular choice for investors. And countries like India are going to keep driving consumption high. So when you put all of these pieces together, it's hard to not see silver prices heading upwards in the long run. The story here isn't just about silver being shiny, it's about being essential for the future. Now moving on, let's understand the factors that will drive the prices of gold. First, gold has always been as a safe haven, right? And with the kind of global uncertainty we're seeing, whether it's geopolitical tensions like the Israel-Hamas conflict or even economic instability, gold naturally becomes an attractive option for investors. It's that go-to-go asset when everything else feels shaky. Now, one major factor is the US dollar. Gold and the dollar have an inverse relationship. The dollar weakens, which might happen due to high US debt levels or interest rate cuts by the Federal Reserve. Gold prices could see a significant push. The use of gold in various industries, such as electronics and healthcare, is expanding. New applications for gold can further boost its industrial demand, potentially leading to higher prices. Therefore, despite current high prices, there still remains potential for future growth. And let's not forget about inflation. Historically, gold has been an excellent hedge against rising prices. If inflation stays sticky, the demand for gold as a store of value could remain strong. Another interesting trend is central bank buying. Did you know central banks around the world, especially in countries like China and India, have been aggressively increasing their gold reserves? This steady demand from central banks acts as a solid support system for prices. Finally, there's the impact of rising investment in ETFs and physical gold. More retail investors are turning to gold not just for jewelry but as a strategic part of their portfolio. And with the global uncertainties unlikely to go away soon, the long term prospects for gold look strong. So, in simple terms, as long as uncertainty, inflation, and central bank buying are in play, gold could continue to shine in the years ahead. Now, moving on to our last segment, which is how to invest in gold and silver. Now, when most people think about investing in gold, their minds might just immediately jump into buying jewelry. But hold on, while jewelry can be a beautiful asset, it's not the smartest option for building wealth. Jewelry often comes with hefty making charges, sometimes as high as 25%, which means you're paying more than just the gold itself. The good news is that today there are several modern, hassle free ways to invest in gold. These options not only allow you to tap into gold's value, but also eliminate concerns about storage, security, and unnecessary costs. Let's explore the smarter ways to invest in gold and silver. Firstly, coins and bars. These are a more efficient way to invest in gold and silver compared to jewelry. Priced based on weight and purity with no making charges, they offer straightforward investments. When selling, you get full market value, making it a good option for those looking for tangible assets. However, you'll need secure storage for your coins and bars. Second is digital gold, which allows you to invest in gold, and some platforms also offer silver without the need to handle or store physical assets. You can buy small amounts of 24 karat pure gold or silver online, starting with as little as 10 rupees. The gold or silver you purchase is securely stored in trusted vaults and can be sold anytime for market value. Platforms like Google Pay, PhonePe, and jewelers like Tanishq and Safegold offer digital gold options, making it flexible and easy way to invest. Now, sovereign gold bonds are another excellent way to invest in gold. These are government backed bonds that allow you to own gold in digital form with the added bonus of earning 2.5% annual interest on your investment. SGBs are issued by the Reserve Bank of India, making them a safe and regulated investment option. The RBI opens SGB subscriptions in tranches a few times each year. You will need to keep an eye on the RBI website to find out when the next subscription period is. Now, gold ETFs. These funds hold physical gold in the portfolio with each unit representing 1 gram of gold. They are traded on stock exchanges, making them liquid and easy to buy and sell with prices directly linked to the market price of gold. Similar to gold ETFs, These funds give exposure to the price movements of silver, making them an easy and liquid way to invest in silver. Then there is gold mutual funds. These funds pool money to invest in gold related securities such as mining companies. They offer indirect exposure to gold and may have additional management fees. Now, which investment is right for you? If you're looking for long term wealth and security, sovereign gold bonds are ideal due to their government backing and low interest income. If you're looking at low cost and flexible investing, digital gold ETFs and silver ETFs offer modern, hassle free ways to invest in gold and silver. Now, physical gold and silver in the form of coins or bars may be more appealing for those seeking tangible assets. By choosing the right method, you can tap into the value of gold and silver without the hassles of physical ownership or storage. Which is the right option for you? Let us know in the comment section. Now, having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.